Welcome to Copytraders Club, where you can learn how to make more money copy trading. I'm Gavin Macaulay, my name and username on eToro. You can continue the conversation on Discord and Facebook. Today is a very special episode since we have a panel of 3 VIP guests, with a format inspired by the Totally Football podcast with James Richardson, one of my podcasting idols. Warning, this episode does contain some strong language and references to acts of a sexual nature. So that's something to look forward to. But perhaps not in front of small children. Or even medium-sized ones. Here we go. In today's TotaleToro episode, we will tackle 4 of the issues of the day for eToro users. Obviously, it should go without saying that we 4 are all eToro enthusiasts and cheerleaders. Otherwise, we wouldn't all be here. Often, of course, it's the heavy users that can be the most perceptive to the glitches and imperfections of any system and spend more time thinking about possible solutions. And let's not forget the overriding aim of Copytraders Club is to help eToro users, in particular copy traders, to do their best, as sometimes that means understanding the system, warts and all. With that all said, these are the 4 subjects for today. Number 1, how to optimize the eToro newsfeed. When is use abuse? We peruse and muse. Number 2, is Gamestop the endgame for the gaming industry? Ideas for copiers who want to join in the game. Number 3, the controversial eToro risk score. How you should use it and why it is risky to accept it at face value. And number 4, should it be closing time for the eToro bar chart? I can't see straight and my performance may be limp. Joining us today, we have 3 friends of the show and A-listers in the eToro universe. First up, B to the A to the sing it from the rooftops. It's the Buffett of Basingstoke, Jay Nemesis. Jay, hello, and we hope you had a wonderful birthday last weekend.
Yeah, it was great, and I didn't listen to that song on it, unfortunately. Maybe I should have. Good song. If you haven't listened, give it a go on YouTube.
Absolutely, I'll second that. Also with us is a young pretender to Jay's crown, all the way from the Basque country. It's Robert Merck. Hello, Robert. You discovered Narnia behind a wardrobe in your new house.
What? I discovered Narnia.
You discovered a secret world behind the wardrobe in your new house. Is that not correct?
Oh, Jesus. Yeah, Jesus. Jeez, you pay attention. Wow, yeah. I did, yeah. It's a contender for the office space, but unfortunately, I had already committed to a pretty big bill to develop my office, so my wife won't allow it. So anyway, there'll be a kid's room or something for when they're bothering me.
So there's no sign of Mr. Tumnus in this secret world? But in your case, I guess it would be Mr. Thumbnail. Terrible joke. All right.
I always feel like a little child when I'm talking to Gav. His jokes are, they just bring me back to when I'm a kid.
They're dad jokes, is that why?
Yeah, probably.
Next level dad jokes.
Okay, I will make sure I delete all that criticism. Completing the dream team, it's my hero, the coroner of copy trading, Andrew Haddon, otherwise known as Felix. Andrew, welcome, and tell us why you've stopped saying that in the intro to your videos.
Sometimes it's better to fly under the radar, shall we say, especially based on the subject I'm going to be talking about today. But yeah, I'm really liking this new nickname you've given me, the coroner of copy trading, and I hope to dissect everyone's opinions today.
Fantastic. Well, that's our superstar panel for the first ever TotaleToro episode with me, James Gavin Macaulay. I should point out that because of the multiplayer aspect of today's game and various jurisdictional COVID restrictions, we're not meeting in person in the Copytraders Clubhouse as normal. We're in fact conducting this chat remotely, so that's a new and exciting departure for us. It could be a few technical hiccups along the way. All right, let's get into it. Number 1, how to optimize the eToro newsfeed. So we're going to consider what constitutes good behaviour, fair play, and potential penalties for egregious breaches of the rules. So ironically, it's Glasgow Rangers fan Andrew Haddon to kick this one off. There's a recent Felix video on this, and we must assume that the listener may not be a subscriber to your channel. Shame on you, listener, if that's the case. So Andrew, please let us know your findings and thoughts on this subject.
Thank you very much, Kevin. So to introduce this topic, what I'd like to say first of all is, from my perspective, eToro has got two unique selling points that brought me to the site. One of them is copy trading, which is why we're all here today. And the second one is the social aspect in the form of the newsfeed. And this goes hand in hand with copy trading. And when these functions are harmonious, it makes eToro a welcoming and enjoyable experience where everyone can get together and make some money. But unfortunately, over the last few months, I've seen two main problems creep up into the social aspect of eToro, which is to be expected now that there's over 20 million clients on the site. So what I'm about to say is in no way a criticism of eToro. So what I'm going to do is talk about each of these two issues in turn, along with some ideas for potential solutions. And for both of those, I'd be very interested to hear what all of you have got to say about it. So the first aspect is spam, which I would consider the more harmless aspect, but still can be very damaging in its own way. And subcategories of that, first of all, is people posting frequently purely for the purpose of attracting attention. For instance, I remember a popular investor I used to copy, and he had a long-term buy and hold portfolio, but he was posting 20 to 30 posts each day, one on each of his stocks, given a day-to-day full analysis of the company. And I think that my phone was pinging constantly with notifications. This is purely done to try and attract attention, and I actually stopped copying the person because of it. It was so annoying. And the second one, which is my personal pet hate when it comes to spam, is people tagging over 5 assets. You're only supposed to tag 5 assets per post. And a lot of people, including PIs, are guilty of spuriously tagging 10, 20, sometimes even more different assets that have no relation to the post in question. And the third type of spam, which I'm sure we've all seen, is these Discord links. Every time you make a post, bang, within seconds, someone's put a Discord link. So those obviously are not as harmful as what I'm about to say later on, but one potential solution, I'd like to give a shout out to a gent called Christian Raukenwald. He's also got a YouTube channel, and he helped me a lot with mine when I started it. He's got a little extension for eToro called Toro Boost, and this basically automatically screens out any post with more than 5 assets. So I was thinking of, if a bedroom programmer can design a program like that, a simple script, then surely eToro could integrate that into the platform and forcibly not allow people to tag any more than 5. Also, traditionally into sports gambling, and there's a site called Betfair, a betting exchange, and they've got live streaming of sport events, but you have to actually have money in your account in order to watch the live streaming. So I was kind of thinking if eToro maybe had a rule where people had to have money in their account in order to post, then a lot of these people posting Discord links, I very much doubt that they have any money in. They've probably just set up the account for that purpose. That would put a puncture in their tires, so to speak. And lastly, I would say, just as with what I'm about to come on to, is harsher punishments and penalties for repeat offenders. So if people knew that maybe they were going to lose their PI status if they consistently were spamming and abusing the newsfeed, then that would be one potential solution.
Yeah, absolutely. As you guys know, I post a video on YouTube. I try to do it most days just for a routine, but it's really, really, really hard for me to curate good quality content every single day. So there's no reason why eToro couldn't put a limit if it's coming from popular investors. Put a limit of like 2 posts per day maximum. 2 quality posts is better than 20 garbage posts. And I think if people put a little bit of time into it and they have one good quality post, it'll get far more sort of attention than, like, here's the thing. If you're putting 10 or 20 posts out a day, the quality of content, it doesn't, like, first of all, in investing, the fundamentals don't change that quick. Unless from one day to the next, you invested in something and it came out it was a fraud and you had no idea. That's pretty rare. But outside of that, the data doesn't really change as often as you might think. So I think, if it's mostly coming from PIs, limit to maximum 2 posts per day. And regarding the extra links, if somebody's not, like, I like to give people as much freedom as possible. So I don't even have a problem with people posting Discord links, but only if, like, I don't post any of that stuff personally, but if you're not investing and you're not part of the community, there's only 1.5 million people with funded accounts. There's 23 or 25 million on there, but there's only 1.2 or 1.5 million funded accounts. If you don't have a funded account, I don't think that you should be able to contribute with all this type of stuff. That cuts out a load of garbage, because there's so many different businesses or services that go on there just to market their businesses. Cut all that out. If you got a funded account, you can share whatever link you want. And PIs, 2 posts per day maximum, 5 links maximum. There's not that much content you can do. There really isn't. And just another point on that, as a PI, like from my experience, I personally believe that there's a much better opportunity to go off the platform and bring people to the platform, if you know what I mean. It's less crowded on YouTube. To go there, build an audience, and bring them to eToro. Everyone's competing for the same audience on eToro. And so I think there's a great opportunity where, as PIs, we could actually continue to build out good quality communities from multi-platforms. Do you know what I mean? But if the platform doesn't function really well, I think there's some issues.
Pretty much, I agree with everything you said. I think also using verified accounts as well, because even if they don't have money, verification is another step you could go if you didn't want to go quite that far. And I suspect that most of these people are not verified accounts. And certainly if they were, they're taking the risk of never coming back to the platform if they break those rules. The only other thing I'd say is that, I'm only posting these Discord links. So you join my Discord, Andrew. I mean, if you could just...
I wasn't meaning you, obviously. Okay, so that spam, as I would say, that's the most harmless of the two, although it is incredibly annoying and can actually obviously cost people money if they fall for someone who's marketing themselves that doesn't actually have any investing ability. But anyway, the second part, which is more sinister really, is abuse. I've certainly noticed an uptick in the last few months of certain threads, certain posts that have attracted offensive and aggressive comments. I made a video about this, which Gavin referenced, even though a couple of days ago I saw a different PI from what I'd featured, and they posted something saying that they felt Gamestop was overvalued, essentially. That's all they were saying. And within an hour, there was 200 comments. And again, some of them were using swear words and accusing the person of being a hedge fund shill and all sorts of really, really nasty stuff that was unwarranted. It wasn't a provocative post. It was well-reasoned argument. So yeah, I think that there's certain trouble spots, certain threads where these take place. But what I was fascinated with is the psychology of it, is that there was a lot of the times the responses I got was people were saying, if you post here, you should know what to expect. So that's using intimidation. It's basically saying, if you post anything on this domain that we own, then you will get abuse, and that's to be expected. And there's also calls for freedom of speech, saying that censorship is wrong. We can say what we like. You just have to deal with it. But I thought the irony was that almost invariably the people who said that were demanding that the PI's anti-GameStop or anti-AMC post was taken down. So what they're saying is they actually do agree with censorship. They just don't agree with their own comments being censored. They only want other people's comments to be censored. So, but my view on freedom of speech and censorship is, when you enter the eToro platform, you agree to eToro's terms and conditions, i.e. the community guidelines. And from that point of view, you do not have complete freedom of speech as you would in the street. In the same way, if I go to the supermarket, I must wear a mask and I must be socially distanced from people, etc. So in certain environments, I would have thought it was obvious your right to freedom of speech or what you wear changes. And you have agreed to observe by eToro's terms and conditions. So therefore, you cannot then, as clearly stated in the guidelines, you cannot post swear words and threatening comments and stuff like that. So speaking of which, in response to my video, some of the choice comments were, someone said they would rather be waterboarded by the CIA than listen to my complete video. Ironically, the average listening time was 5 minutes of a 30-minute video, so most people hadn't even heard my argument in full. They just made an assumption about that I was defending certain PIs. Also, they said they'd rather listen to Nicola Sturgeon's whiny voice than mine. And he also said mistakenly that I was a Celtic fan, which I think was the biggest insult of the three. So also, quite staggeringly, someone came on there in my opinion, masquerading as a solicitor, threatening to sue me for breaching their client's privacy by sharing a comment that someone made. But I then pointed out that all comments on eToro are visible not only to the 20 million clients of eToro, but also to non-eToro clients. So if I Google Jay Nemesis eToro, I can read all Jay's comments without logging into eToro. So I checked that with my account manager, and surprise, surprise, I wasn't right. I mean, if only I had a law degree. Oh, wait a minute, I do have a law degree. So yeah, and it just happened that this person had exactly the same name as one of the comments that had featured in the video, but I'm sure they're not related at all. It was just a complete coincidence. So yeah, the potential solutions were, automated solutions include having a report abuse button, because we've got a report spam button, having a block or a mute button, having a dislike button like YouTube, having profanity filters, or other automated solutions. The irony I found here as well is that abusers actually want these things because they want to be able to mute the anti-Gamestop or the anti-AMC or the anti-Tesla comments. They don't want to hear that because they're living in an echo chamber. So I think it'd be welcomed by both sides, the abusers and the people that are being abused. But I think ultimately, though, there needs to be zero tolerance for abuse and intimidation, especially when it comes to racism, sexism, homophobia, which unfortunately a lot of these comments have. And simply remove the people from the platform, do not pass go, do not collect 200 quid. So that's the end of my argument on that one.
Yeah, it surprises me that users feel quite as free to be abusive on eToro as they do elsewhere on the internet. Because elsewhere on the internet, they have the cloak of anonymity. Whereas on eToro, your name is there. They know who you are. And, it's supposed to be a civilized platform for business-related matters. I find it extraordinary that they come out with some of the stuff they come out with. And some of it is horrific, and of course, and in the context, it's obviously not to be made light of in any way, but I do think there was a part of Andrew that enjoyed all the swear words in the video that he made. References to bestiality even.
Yes, I noticed that was a recurrent theme. Although I do realise the ape is not a literal thing. It's more of a kind of name that they've adopted. But it was quite apt for some of the comments that were there.
I'm trying to lead you down the path of telling us what that ape bestiality remark was. But I don't think you're going to say it. No,
no, I couldn't possibly repeat these.
I'm going to say it. It's my podcast, so I'm going to say it. Accusations were leveled that there may have been some sucking of apes' cocks going on, I believe was the term.
Don't forget dog nonsense as well. I don't know whether that's preying on juvenile dogs or whether not even wait until the dogs are fully grown.
And of course, most of the cocks that have ever been sucked in history have been apes' cocks. Because after all, humans are one of the 5 great apes.
I can't handle this conversation anymore.
So bonus points to the panel if you can tell me what the other 4 great apes are.
Andrew, you're the smartest out of all of us. You have to have an answer for that.
Chimpanzees.
Chimpanzees, correct.
Orangutan.
Orangutans, correct.
I have no idea. You're just asking for types of monkeys.
We're all looking at you, Andrew. We're clueless.
Gorilla.
No, not gorilla is Andrew's canon it here. 1 more to go, Andrew. Human, chimpanzee, orangutan, gorilla, and gibbons is the answer.
Never got
Those
that
are the 5 great apes. Okay, so what else do we want to talk about? You two, anything to say about Andrew's latest comments?
Yeah, I was going to say something, but I don't know if it's relevant now. I was just going to mention just on like eToro's challenge regarding trying to moderate the platforms. It's way different to other platforms because you look at something like Twitter or Facebook. Up until now, most of the revenue came from advertising, right? So they moderate a good community. They try and stay as centered as possible. Twitter's a little bit left-leaning, Facebook's a little bit right-leaning, but everybody's leaning somewhere based on where the community is. But they get monetized based on advertising revenue, whereas eToro is completely different, where it's on the spreads of each trade. So if somebody's on there with a couple of $1 million, let's assume somebody has a couple of $1 million and they decide to throw out a racial slur or something like that, how do they moderate that when possibly a decent chunk of their revenue per user comes from this one person? It's a big challenge. I don't envy them at all, but it's a big challenge in order to try and moderate that and be fair, taking out the way in which they monetize their platform. So I agree with everything Andrew said, but I don't know if it's as an easy a fix as that might be the case. I'm not sure.
Yeah, kind of theory crafting off that a little bit, but maybe there's some room for gamification and trying to incentivize good behavior with lower spread fees or things like that, and disincentivize bad behavior with higher spread fees, or restricting access to certain things on the website, or leverage, or whatever it may be.
There's no way they could actually talk about fines, is there? Is fines a ridiculous thing to think of?
I don't know if it is necessarily. I think it could work.
Especially if the comments are only allowed to be given by people with funded accounts. If that was in the terms of service, repeated breaches, you'll get fined this amount because they've got your money. I imagine it's not possible to do that.
Well, I like Jay's idea. I'll tell you why I like Jay's idea. It's kind of like, like Jay's likes cryptocurrencies, but like basic attention token, utility token. It's a utility token on the Brave browser. But depending on so we could create posts and we could be incentivized by these tokens. We could be rewarded specific tokens, eToro tokens, and build up reputation using a utility token. It doesn't have to have any monetary value, but it could definitely have some social value. And that could be certainly a way where they can incentivize people to, maybe they can convert into something like lower fees, like what Jay was saying. So if I write a good post and it's upvoted, I'm incentivized to write that post that gets upvoted, and maybe my fees go down. I can transfer those utility tokens for lower spread fees or something like that. And that would change the nature of the content on the platform. You're incentivizing good quality content and sort of like good behavior or whatever. And there's some sort of reward at the end of it. I don't know. I think that's a great idea.
Yeah, basic attention token combined with Binance coin.
There you
essentially.
go. Yeah,
that'd be interesting.
I guess the challenges with a lot of this stuff is you're giving eToro a lot of power and a lot of authority to decide what's right and what's wrong. Even eToro at the moment deciding what post to pin, like if they pin a pro-Tesla or an anti-Tesla post on that newsfeed, given the amount of money that's swirling around eToro, this means eToro themselves could potentially influence markets. So that would be, and if you combine that with them giving out credits to good and bad behavior, it gives eToro quite a lot of power over which way markets are moving in, or what people do well on the platform. But certainly worth considering.
What if the community are the one that determine that, like if it's voted up, it gets, like it's kind of like a Reddit type model where you get upvotes and then it's like supposed to be the best quality post. But here's the problem with that as well. All the apes come together and there's an ape post that's garbage and they all vote it up because they're like for the cause. Yeah.
That's exactly what I was going to say. Is that, if you have it, that's the problem with a dislike button, is what I could see as a lot of high quality posts would be hidden by people collaborating together to downvote it, on subgroups and stuff off eToro. So almost any solution you can think of can be abused by people who are originally doing the abuse.
I think it's interesting to think about this, right? Because although it is slightly different for eToro because of what you said about having these funded accounts, Facebook and Twitter and the like are all dealing with exactly the same issue, right? How do you police a community when it starts getting big? And if you have this tribalism, right? So you can have the Wall Street Bets group come in and just downvote anything negative about GameStop, for example. But the way that they're handling it is kind of interesting. So Facebook, for example, have got a third-party panel that they've created of neutral people that they essentially are paying to monitor and make these big key decisions. And it's similar to the justice system, right? You have these kind of standout cases that then set precedent for anything else going forward. So, I mean, I think really what you need, like, there is no perfect solution, and I think we have to accept that. But you can kind of combine all of these things, giving eToro some power, giving users some power with upvoting and downvoting, and potentially having a supreme court, if you will, that it goes to if there is some sort of a big dispute between everyone involved. I think that's really the only way that you can do it. But constructing that structure and testing it in a live environment, which is the only real way of doing it, that in itself is a big challenge. So, whatever eToro come up with to try and tackle this problem, I think is going to take quite a long time to get on top of.
Yeah.
Okay, so our conclusion seems to be that running a multi-billion-dollar fintech platform is quite tricky.
A little bit, yeah.
Okay, let's move on to our second issue of the day. Is Gamestop the end game for the gaming industry? Jay, you're a big gamer. As everyone knows, the way you like to relax after many hours of staring at a screen of blinking colors and twiddling your fingers is to stare at a screen of blinking colors and twiddle your fingers. So what are your views on this subject?
So, unlike Andrew and probably everyone else, I'm nowhere near as prepared enough to organize some sort of a script or, even bullet points about what I'm going to discuss. But essentially, like, the gist of this, I think, really is talking about what's happening with Wall Street Bets and with GameStop. I'm not going to focus on the fundamentals. I do, I've shared quite vocally my opinion on social media and stuff about GameStop. And I do have a lot of experience in the industry on exactly what GameStop are meant to be doing, right? Which is converting this legacy business into something that can survive. I don't think that that's viable, but that's kind of besides the point about what I wanted to talk about a little bit. So if anyone wants to ask me, maybe we can talk about that in the future or something. But I think what we're witnessing, to quote Warren Buffett, he always claimed that the stock market is a voting machine in the short term and a weighing machine in the long term. And I think what's happening with GameStop could be that we are seeing actually that the market is just a voting machine all of the time. You do have the fundamentals that back up what a company should logically be valued at. But when logic goes out of the window and you get outvoted, the market stays irrational for a very, very long time. And I think that's what we're seeing with GameStop. And it's an interesting kind of development that's going on as retailers kind of moving into this space in a bigger and bigger way. And what's going on with the kind of education of these users, and are they actually really learning about fundamentals, or are we witnessing a new form of mass market manipulation? So yeah, that's what it was really. I just kind of wanted to open it up and see what people's opinions are.
It's kind of like the Japanese. The Japanese get a job for life. They go to work. They stay working for the same company forever, in like perpetuity till the day that they retire. They kind of marry themselves to their job. And I was thinking to myself, is that what the future is going to be? Because we've seen a massive uptick in retail traders over the past 12, 18 months. I think about 28% of the entire capital is coming from retail investors, which is the highest it's ever been. And I was thinking that are we moving into a world where retail start to follow sort of specific companies in perpetuity forever? It's kind of like what they marry themselves to. And as much as I think that is possible, at the same time, and I'd love to get your feedback on this, I don't think it's actually possible for that to occur, because if GameStop, for argument's sake, can't turn a consistent profit year on year, how are they going to finance operations? Through debt or through equity? And if it's true debt, well, then it's just going to constantly be rolling debt, increasing the debt on the balance sheet. You're going to have more burden on the interest payment until the banks stop financing you, and then you start issuing equity. And so if you think about, like, a lot of people believe that short selling drives the share price of a stock lower, which is not true. It provides equity. What really drives the share price lower is a lack of demand. And so let's say you have a situation where GameStop can't produce a consistent profit and they need to finance operations via equity, and there's no more demand for the share price, it'll still go down, right? And so when you're looking at these valuations today, I think they're bizarre. GameStop, in my view, like, there's loads of these old really good quality games like Final Fantasy and all these. I never played them, but I remember those brands that you could probably pick up cheap, rework them, and have like a Netflix business for gaming online. And I think that's what GameStop should be doing. But the idea of selling hardware and discs and all that sort of stuff, and the idea of just transitioning it into, you know, an Amazon business doesn't sound like a sustainable opportunity to me. So I have a couple of questions. Are retail investors thinking like super long term, this new Cathy Wood type of investor where they're going to buy into a company, they're going to hold it for 40 years like the Japanese do with their job? And if that's the case, is that enough for the equity to remain at a significant premium? I don't think so. I think in the near term that could happen for 3 to 5 years, but then eventually, as you continue to issue equity in order to finance operations, you have more supply of shares. And then if there's a lack of demand, I mean, I could easily see a lot of these companies still go bankrupt, including GameStop. Like, I think the jury's still out. I don't know if they can sustainably build a profitable business long term.
So here's the interesting thing, right? I was on Wall Street Bets, as one does on occasions, and I was looking at this, and one of the kind of memes that they were going with is that if they keep funding it enough, they can just acquire Apple. Now that obviously sounds entirely ludicrous, right? The $2 trillion company or whatever, but there is potentially some truth to that, right? Like if they can grow the movement big enough and raise enough capital, they can transition into anything. They could start building new electric cars, you know, they could do whatever they want. And it's like this, it's kind of like crowdfunding. It's crowdfunding a company on the stock market. And really, you know, they're entirely trusting management to use that in, you know, the most sensible way. But really, there is no rule book saying that they have to try and turn around the company. They could do all sorts of things. They could just go through, you know, a kind of merger and acquisition route to get themselves out of this problem, and just merge with other successful companies. Like it's a really, really strange and bizarre world. It's almost like a SPAC, you know, potentially. And I feel like if you look at the way that SPACs are priced, maybe this is, you know. This is kind of what's leading this kind of crazy valuation on GameStop. Maybe that's what they're thinking. I don't know. It's pretty bizarre. But for the long term of GameStop, I don't see it as being possible to sustain it in that industry without becoming a competitor to Microsoft and Google and the people that own the entire gaming ecosystems. That's the only way I can see it working.
Yeah, relating to what Jay is saying there, I've noticed the narrative has shifted on the GameStop thread. When they were first doing it, it was all about combating hedge funds, manipulating the market upwards. But I'm seeing a lot of arguments being put forward that GameStop is actually undervalued and is a good investment, probably for the reasons Jay mentioned. I find it difficult to believe that something that's 50 times as much as what it was 6 months ago or whatever could possibly be good value, because the reasons they're giving is new CEO, debt's been reduced or eliminated, a new online strategy. But I think as a keen gamer myself, you know, the main challenges with any physical game store, or even if they move digital, is, you know, say PlayStation 5, there's a digital edition of the console. So anyone who buys that, and it's £100 cheaper than the other version, has to buy their games from PlayStation Store. So even if GameStop was selling digital downloads or this, that, or the next thing, or selling games like an Amazon online retailer, then Microsoft and Sony are looking to completely take control of that. There won't be a second-hand market. Streaming's another thing, like Google Stadia. Not that that's all that good. So yeah, I think that whatever direction GameStop takes in the gaming industry, it's pretty much doomed to failure. But yeah, as Jay says, they could move into other areas. But I think in general, overarching point is we shouldn't assume just because things have always worked a certain way in the past that they will continue like that for future. So yeah, maybe investing will be driven by these huge groups of retail investors clubbing together. And in fairness to them, they're seeing it as the market's been manipulated for years by the big players, so they're just kind of giving them a taste of their own medicine by combining together and manipulating the market in the other direction. So there is some justification and some merit in what they're doing.
I think though that, like, although that's plausible, I don't think it works with any average company. So if you think about, like, for argument's sake, AMC, GameStop, those type of companies, one of the really unique sort of aspects of those companies is they had 100% or a very high percent short float. So if you think about short selling, you're borrowing shares and then you're selling it into the market, you got to buy those back eventually to close out the position. And so I think what happened was you had a couple of very smart people. Michael Burry started this trend back in, I think, 2018, 2019, recognized that GameStop's trading at one times cash. If he could increase a little bit of demand in the share price and the share price pushed a little bit higher, all of those shorts, there was 127%, I believe, of the float short. All of those shorts would have to close their position, driving the share price higher. But if you have all these apes or whatever they call themselves bidding up, and it doesn't have to be a huge amount, but if they bid it up, it causes this sort of scenario where it's like a chain reaction, self-fulfilling prophecy, where it goes straight up into a blow off top until all the shorts are closed. But after that, let's say all the shorts are gone. Where does all the demand come from? Retail it's big, but it's not that big. And of the retail community, I just wish there was a little bit more transparency. The original one by that guy, Kitty, whatever his name is, Roaring Kitty, his original thesis and Michael Burry's, that's the entire thesis. There's over 100% short float. They're not going to go bankrupt in the next 12 to 18 months, so we have a chance to squeeze the funds. That's the entire thesis. In my view, there is zero value in GameStop in its current form, and there's a huge risk as to whether their earnings are going to be sustainable long term. As of right now, it looks quite successful that they'll be able to transition into an online gaming, but at what point does digital eat the market? And that's sort of what I think about. And I think that we spend a lot of time thinking about, for argument's sake, GameStop like changing the world, which is a possibility. I'd love to see it with a company that doesn't have 100% short float. You know what I mean? And that would be the true test of these changing winds. But I think it's like history always rhymes. And this is like one of those events that will be 1 in 100 years. Like, I don't think I'll ever see it again. I think the scars of this, you look at Gabe Polkin's fund, Melvin Capital's down 46% in the first 6 months. I think the pain of this, and Gabe Polkin is recognized as one of the best long short managers in the game. You know, like he's one of the top investors out there. And I think that once all this debacle is over, I don't know if it would repeat.
Okay, I'm going to try and bring it back to relevance for copiers. Are there any PIs around who are embracing this sort of new paradigm thesis? Or what are the views that you're aware of from PIs that are still behind GME?
Gasper Soppy, who's a PI, and he is really embracing the meme culture, but he's really spending a lot of time sort of analyzing, and I really enjoy listening to what he has to say.
Well, you'll enjoy next Tuesday's episode then.
Oh, he's coming on? Oh, I'd love you to grill him on this, actually.
Well, he's already been recorded. He's coming out on Tuesday.
Oh, excellent. I'm going to be listening to it. But he's got a great sort of philosophy on markets. It's very much fundamental driven, but he's also taken in these cultural shifts as well. Been reading a lot of his tweets, and I've been reading a lot of his comments. And he's someone that seems to recognize that fundamentals drive markets, but we're in a period where cultural shifts are happening, and he's asking a lot of questions. He's someone very interesting that I think more people should follow. Absolutely. But outside of that, I haven't really come across anyone that's really recognizing the cultural shift, but also understanding the fundamentals are very important.
Yeah, a point I had to make, it's not so much PIs are into it just now, but there was a PI, who I won't name, but you can probably work out who it is, who made a lot of money from GameStop in January. And what interested me was he positioned himself as a value investor. In fact, he's got the eToro badge as such. And at that time, he definitely was, but he allowed GameStop to run to the point where it was 40% of his portfolio at one time. So I think when it gets to that level, you can't really say you're a value investor, because there is an argument to say, well, if it's all profit, then if you lose it, it's not really a loss. But I'm of the opinion that your portfolio is whatever it is in any period of time. It doesn't really matter what you started with. You have to manage the sum you've got at the moment. So to have a portfolio that's 40% in GameStop, which briefly he did, I think that casts into doubt him being a value investor.
So going on a really slight tangent, talking about that though, last night I was actually in a call with about 4 or 5 other popular investors, and we were talking about this, and maybe this is a topic we should discuss on a future episode. But we were discussing, should eToro have policed that move, right? Because his own capital is invested, and for him, he was 1,000% up or something, and you could make an argument that the people that copied him early on And if you were in that position, you would probably leave some of it to run because, why not? The sky is the limit potentially on something like that. Not so much the sky's the limit, but it could run a long way. It could hit 2,000% or something. And so we were kind of debating the pros and cons of it, right? Because for new copiers that were copying, they were buying in at this insanely high price, even though it's a smaller percentage of the portfolio because it's copying the invested amount. They were buying in at this insanely high price, and it's like, should eToro protect those copiers? At the same time, by doing that, they would potentially be harming copiers that were in for that original value trade, who would have wanted to let that run, who have been with that popular investor for months and months and months, waiting for this big multi-bag moment, and now potentially it could be controlled. So that's kind of another interesting debate that's kind of raised out of this whole thing.
Well, I always have a question like, what's a value investor and what's a? I think everybody, even people that call it, characterize themselves as growth investors, they're buying value, they're buying
future value,
the future growth of the company. Yeah, exactly. So I always have a question as like, what is a value investor? What is anything, right? We're investing, we're looking for arbitrage today versus the time in the future. And then the second thing is when you invest in a portfolio, it's less about the positions you're buying. Like people always say to me, Rob, I can't invest in the portfolio because you have Palantir and I don't like Palantir. And I think what a lot of people need to recognize is that you're buying the temperament of the portfolio manager, right? So, like looking at historical results is very important because it'll give you some sort of context into how they dealt during difficult times. Whereas if somebody has never been through, for argument's sake, a 2008 type crash, you don't know how they're going to behave if and when that happens again. And so when you're investing in a PI's portfolio, you're investing in that person's temperament. And so I know exactly who you're talking about, but allowing it to get up to 40% of the portfolio, he did close it pretty close to the darn highs. And from there, he rotated all of those profits. And a lot of the abuse started when he closed out of that position, because he said, look, this just doesn't make any sense to me. I'm going to take profit. And in that circumstance, that exact example, I would actually add more funds to that portfolio because it shows that he's conscious that he has a unique opportunity to see a profit run and he knows exactly when to get out. And so like, should eToro jump in? Here's another question. What if I invested in a company after it's already up 1,000%? It doesn't show it up in my portfolio. How would eToro police that? If they didn't know my strategy or exactly why I'd be getting involved in it. So there's a couple of questions that I'd have. First of all, what is a value investor? What's a growth investor? What's any investor? We're looking for arbitrage versus time. We're looking for some sort of margin of safety. Is that the buzzword? And then secondly, you're buying the PI's temperament. And I think it's really important that we as popular investors have to disclose what we do in these moments, like what is the plan, so that when it happens, if we're deviating from that plan, you got to get out, and so, I think it comes down to candor and understanding that you're trusting somebody to do, like, I didn't buy into GameStop. I wish I did, but I don't know if I would have held on to it for as long as that specific person. Go ahead, Andrew.
I think we're going to see this problem more and more because already in the last year or so, we've seen NEO, Tesla, Cardano, Ethereum, GameStop, AMC going up by hundreds or even thousands of percents, and these go from making a small percentage to a high percentage of the portfolio. So where it relates to Copytraders is this kind of thing about, the portfolio you're inheriting compared to the one that the PI has at that time, given that you copy the original values, not the current values. So it's a problem we're going to see more and more often. And as Robert says, I guess it's having confidence in the person's ability to manage their portfolio and for them to recognize when that position is making up too much of their portfolio or when they think it's reached a peak and bail out. And the PI in question did, in retrospect, come out at the perfect time. But I just thought at that particular moment, 40% of your money in GameStop was certainly not a safe portfolio, where because of the way the risk score works, that actually showed up as quite low risk because it was based on the original allocation, not the current one. So it's just a little quirk that we need to bear in mind when copying people.
Well, thank you for mentioning the risk score there, Andrew, which brings us nicely on to number 3. of our 4 subjects, the controversial eToro risk score. I've yet to find anyone who uses eToro who's prepared to give the risk score the thumbs up as it is. It reminds me of Northern Irish politics, where they say, if you're not completely confused, you've no idea what's going on. In a sense, that's similar, since I imagine the only people who are happy with the risk score are those who have no idea how it's calculated or what it truly represents. Robert.
Yeah, so the risk score is kind of interesting. I personally believe that the risk score probably needs to be updated. And I think there's a lot of confusion about understanding risk in a specific portfolio based on the risk score. So let's go over to the article that eToro explained the risk score. Let's better understand how they calculate the risk score and what changes I believe that could be made to prevent possible abuse on the platform, which we'll talk about in a moment, from people that might have a risk score that doesn't necessarily represent their risk, or better understand the risk versus the return long-term from the portfolio. So let's read off their article, how they calculate it first and foremost, so you guys, the listener, understand exactly how this works. So from their article, and this is an old article, this is from 2014, June 2nd, 2014. And it says how it works. Without going into the hardcore math algorithms, the basic idea is that every instrument has an average daily movement, which indicates how volatile it is. Let's say instrument X shifts an average of around 2% a day. During a given day, it usually goes up or down around 2% from its price at the beginning of the day. Statistically, if we multiply this average change by 3, we create a range that will be correct 99% of the time. Okay, so for those of you that don't know, that is what we call ATR, average true range. And so to explain to you guys what the true range is, let's say you've got a candlestick. A candle opens and it closes, but before it opens and it closes, it has a wick and it also has a tail. And at the very low point of that tail and at the very high point of that wick, that is the true range. It's the true range of the entire day. And what eToro are doing is they're taking the average over a specific number of days to calculate the volatility in the portfolio, and they're weighting it to the position. So let's say I've got a position, I've got 10% allocated to a company that has, a true range on average over the past month of 10%, 1% volatility be added to the portfolio for that position. I hope that makes sense. And so essentially, we don't really know over what time frame they are breaking down the ATR. However, it does give us some sort of indication as to what the volatility per risk score would be. So I'll give you an example of my risk score is 5, and the max volatility should be somewhere between 3.9% and 5.4%, no more than 5.4%, which lines up with the standard deviation of the portfolio of 4.22%. Now, I don't know at what time frame that is, but when we look on eToro, it says the last 7-day risk score is whatever it may be. Mine's currently 5. And so it's somewhere between 7 and 30 days, which I think is far too short when you're looking at a longer term portfolio. One thing that I love about eToro and why I constantly promote the platform is because there's so much focus on long-term gains as opposed to short-term trading. Yet the way they measure the risk is very much on a very short-term basis. And a lot of people are coming to me recently, and I didn't realize this. This is why I looked into it. And they're saying, Rob, your risk score is 5. Have you got any plans to bring that lower? Now, last year when I started on eToro, I only had 30% invested. And it was 15% long, 15% short, and 70% in cash. And I had a risk score of 3. And then that changed in October, and I started investing more. And by November, I think I was fully invested. My risk score went from 3, 4, and 5. And I never knew why it was increasing. That's essentially why it was increasing. And what I began to realize, and this also carries over to, for argument's sake, some other people on eToro that have been receiving an awful lot of abuse. And there's one PI who is an elite pro who has gotten a disproportionate amount of abuse on the platform. And I think a lot of it's got to do with people not really recognizing the risks that they're taking in that specific portfolio. And there are a couple of problems with the way in which they calculate it. It does say it factors in leverage, but I don't think it does, because when I analyze this person's portfolio, they had a risk score of 3. And that means that they should only see, I think it was like 1.8%. That's the average true range over 7 days. That's all they should see.
When I went through their portfolio, they had 13% in cash, and they had the rest of it was utilized. They had leverage on the NASDAQ, a 10x leverage position on the NASDAQ. So 80% in the NASDAQ, 30% in gold, 50% in the dollar, and 45% in different tech stocks. That's 205% plus 12, 13% in cash. So they had 220% invested, yet the risk score is showing 3, which is completely disproportionate at the risk that they're taking. So when I look at something like that, if somebody's looking for a low risk, that is absolutely 150 gazillion% not the portfolio you want to be invested in. However, that specific person has fantastic returns. So if you want outsized returns, you have to take outsized risk, and it should be recognized appropriately in my view. And so more recently, this specific investor had an incredible run up and then a bit of a pullback. And on that pullback, a lot of people started shouting abuse. And I think a lot of it has to do with not fully recognizing what you're buying into. And I think there are better ways in which you can measure the risk score. I don't think average true range is a very appropriate way. I think that's very good for setting stop losses, right? So you get the average true range, you triple it up, and then that's your stop loss if you want to be a risk reward type trader. But to measure risk, I don't think it's a good enough approach. There is different methods that they use, such as the Sharpe ratio, which eToro actually calculate for popular investors. Sharpe ratio essentially measures the risk relative to a risk-free rate, which would be the 10-year bond. So I can go and I can collect 1.5%, 1.6% risk-free. It's guaranteed by the US government. So it measures my returns relative to a risk-free rate, relative to a benchmark, and it factors in the standard deviation per month. And that standard deviation would be the volatility in the portfolio over a given month. And that'll give you a score. Anything above 1 is good. Anything above 2 is very good. Anything above 3 is excellent. And essentially what that means is you are generating returns that are outperforming the market with lower risk. And so something like that, a copier could look at it and say, oh, God, okay, this guy's portfolio long-term has been able to generate better returns with lower risk than the S&P 500, which is what they measure it against. There's a better way to do it again, and it's called the Sortino ratio. And the Sortino ratio, so with the Sharpe ratio, and this is a problem as well with average true range, using average true range, both of those are indiscriminate to upside volatility and downside volatility. So when you're looking at your portfolio, it's all about upside gains. However, if you have, let's say, a 10% move on the upside, that will be affecting your Sharpe ratio. That the volatility will affect your Sharpe ratio because it factors in their standard deviation. When you're looking at the Sortino ratio, it's the same as the Sharpe ratio, but it doesn't penalize you for upside moves. And so it's a fair reflection of the risk versus reward. And when I'm looking at it and people are saying, you know, Rob, when are you getting your risk score down? I was like, look, there's nothing I can do about it. I cannot change my strategy or my process in order to bring my risk score down. And so as of right now, you can look at, for argument's sake, the max drawdown, the portfolio, which will give you some sort of idea as to what the standard deviation is. You can look at a portfolio's returns relative to their drawdowns. These type of things, I think, are better ways for a copier to try and measure the volatility in a portfolio, because in my view, I think that the current way in which the risk score is calculated is far too rudimentary, and it doesn't give you clear insight.
Yeah, I mean, I basically agree with pretty much everything you've outlined there. People should be looking at drawdown. That should be front and center. I think the Sharpe ratio and the Sorrentino ratio should be there. That's my favorite by far. I love that, and I entirely subscribe to the idea that, you know, if your goal is to make profit, you know, why is it considered a risk when you actually do? You know, when you achieve that goal, you're you know, punished for it essentially in terms of your risk score. You could be the person that found Gamestop before it happened, put 100% of your money in it, 100% certain this is going to happen. You've got insider information even potentially, and it would consider that to be an incredibly high risk after the fact, after it's made you that money. Which is totally ludicrous. There was another point I had, but I've entirely forgotten it. So I'll let Andrew jump in.
Yeah, 2 points on that. First one was, I know the PI Robert's talking about. I think maybe the reason why the risk was low was because they had a NASDAQ short position leveraged, and they had a gold long position leveraged, and they also had some stocks which were long. So the risk score does actually take into account correlation. So that'll be why their risk score was 3, maybe, even though they had those 205% essentially.
No, it was a long position.
Yeah, it's long.
Was it low?
Yeah, it's still in the portfolio, yeah.
Well, that throws that theory out the water. Oh, okay. I know they initially did have a short position on Nasdaq, but forget that theory. I think they were also short, or they are short in crypto as well at the moment. So these things are taken into account by eToro. What I was going to just say is, yeah, I know the criticisms, but I mean, what I would say is generally, though, you've got to ask yourself: is the risk score doing their job? And the people who are 6 or below generally, I think, are keeping their copiers funds safe, whereas the people who I've seen hitting 7 or exceeding it, you get a lot of moaning and groaning that they're not copyable. Like there was a certain non-PI last year who made something like 900%, and everyone was saying, I want to be able to copy this person. This year they're over 50% or down, or roughly 50% down. And that doesn't really get mentioned as much. So I think in general it is safeguarding copiers' funds. It may not be the best method of measuring it, but it just does give that alarm bell when someone's portfolio gets too volatile. But I concede it is also penalising a lot of people who are making gains at the same time.
Just on that point, I'm not going to name names, but I know when I say this characteristic of this portfolio, you know exactly who I'm talking about. There's a portfolio where somebody has 51.5% of their capital in one position, and that person has a risk score of 5. And the reason why I bring that up is because last year, fantastic year, this year down pretty decent, double digits anyway. The reason why I bring that up is because I don't know if you guys remember, but last year when I started anyway, I was like checking out different PIs. There was a fairly new portfolio on there. I just remember that the tag name was ELS Investor, whatever, something like that. Portfolio goes up 66% in like 5 months, gets the green star over 5 million, puts like 50% of the portfolio short. Crude oil loses 30% in like 2-3 weeks, gets kicked out of the program. From what I remember, that portfolio also had a low risk score. And I guess what the point that I'm trying to say is when you're measuring risk on a 7-day basis based on the volatility, let's say this specific person in question that has 51.5% of their portfolio in one position. Let's say tomorrow the earnings come out, it's a bad earnings, and that position is down 20%. That's not factored into the last 7-day volatility. And it's like, whereas when you're looking at the Sharpe ratio long term, it gives you more of an indication as to the temperament, right? Because that fluctuates long term. So it's going to be very volatile at the beginning, and then it smooths out long term. Anything above 1, you know that this person is able to generate safer returns relative to the market. And so for me, it's like my biggest fear on eToro, and I guess I'm in a good position right now because I don't have to rely on the management fee that you get from managing funds. But my biggest fear is that I'll be forced into changing my strategy or something because people don't like, because of the risk score. I'm incentivized to change my strategy, keep my risk score lower, but that's going to make my returns suffer. So for me, I got to remain consistent with my strategy. And if I have a risk score of 5, that's fine. But I think there's better ways of reflecting the risk in a portfolio. I don't know what you guys think about that, or if you've had challenges with that in the past.
Yeah, I mean, that's a concern I have as well, to be honest. I think even of my own trades, thinking of like Peloton and AMD, which, I've been incredibly vocal about, and, these are incredibly high conviction plays for me and have been for, a good amount of time. And it's a constant battle of, how far can I push this before it tips my risk score over? And I don't think I should have to be thinking about that for what is the highest conviction play I have by a long margin. And I know that there are other popular investors who have much smaller, less diversified portfolios, and that is their strategy. And I think the risk score restricts them from executing that strategy. And I think that's not what the risk score should be doing, right? It shouldn't be pigeonholing you into kind of fitting into that criteria. You shouldn't be pushing your portfolio into something that is deemed to be safer, when in reality it could actually lead you to take what, in your opinion, would be more risky behavior.
Just a quick point to say that I think some of the best PIs are the ones who manage to do that navigation of the risk score between 6 and 7 and just not straight over, such as Jay, because that is kind of maximizing returns while still not going over it. But one thing I'd like to see is if there's some way eToro could do before you make a trade, if it could tell you what impact that would have on your risk score, like say if I keyed in, I want to put 5% more in Apple, then it would show you risk score before and after to a decimal point as well. Like this will increase your risk from 4.5 to 4.9. And it just really would, certainly for PIs, give you that granular control over where your risk score is sitting. Whereas at the moment, there is a bit of guesswork involved in whether you're like a 6.1 or a 6.9, so to speak.
Well, some fantastic learned opinions there from our panel. I have nothing at all to add. And I guess the controversy will continue to rumble on. Should it be closing time for the eToro bar chart? As I said, closing time and I can't see straight and my performance may be limp. So this must be my round, lads. Since I started on eToro, I began with an initial amount as a newbie, small amount. I doubled it after a few months. Then I added a bit more. Then I closed one copy, took what I considered to be the excess from that copy, and reallocated it among my PIs and some crypto positions. So I'm 6 months in, and I already feel like the stats on eToro, both the bar chart and the line graph, are largely meaningless to me, since there seem to be so far from an accurate picture of where I'm at. So I want to talk about the bar chart in particular. It's calculated using total return, which I think we would all agree is a quite simplistic view of performance. The question is whether it should be using IRR. That's one of the questions I often hear. So the main difference between total return and IRR is the total return ignores when money is deposited or withdrawn. So the month when either happens will have skewed results. This is a problem when, for example, a PI who's having a bad month deposits money near the end of the month to reduce the monthly loss that will be reported. Maybe not with the intent of doing that, but that's certainly the effect. He may have been heading for an 11% loss, but adds some funds, so the loss ends up at, say, 8%. And I think I noticed Andrew just communicating with somebody about an example of that in the last day or so. The other situation is more the situation that I was met with. An investor or copier won't have reliable results during months when they deposit or withdraw. E.g., when I doubled my bank account, I'm not even sure when during the month that was. If it was near the end of the month, I could have been heading for a 10% positive, but the stats would then show closer to a 5% return. So if you multiply this out by several copier deposits and withdrawals and several PIs in a copier's portfolio, very quickly you can see a statistical picture that is so far from the truth as to be meaningless. So, internal rate of return accounts for the timing of deposits and withdrawals. Question 1. Would a display with this method not be better for showing the actual truth?
So yeah, I 100% agree with you. When as a PI, what frustrates me most about eToro is that I'm discouraged from backing myself, even though I'm getting everybody else, encouraging everyone else to back myself. And I don't know why, for argument's sake, PIs can't have a second account that copies their portfolio. And if a new PI, instead of just slowly building up their account, they can just have this secondary account that's included as the same. And then like you're a copier as well into your own portfolio, but it can be included. Because, like for me on eToro, okay, so I'm going to get everyone to back me, but I'm only going to put in a small amount of money and leave it there for a number of years. It doesn't make a lot of sense to me. And so I feel like I would like to keep building it out. And if we had the total return, but it wasn't added to as a PI, that would make a lot of sense. If you couldn't, let's say it was your primary account, the minute you become a PI, you need to have a certain level, and then that's just frozen. And then everything else goes into a second account and you keep having to add to it. But for someone that's a copier, I agree with you. It should be normalized to your real return, even with your deposits. I don't know. Does that make sense?
I mean, I think, I think that makes complete sense. And it's something that I've been really frustrated with for a long time. And actually, I pride myself on the fact that I don't deposit or withdraw anything from that account. unless it's absolutely necessary. In the past 5 years on eToro, I think I've done it twice, and once was because eToro changed the rules. In fact, the first time might have been as well, actually. So yeah, I pride myself on that, but I shouldn't. What I should pride myself on is adding to that account, and as you say, I want to back myself, but I'm not in a I'm not allowed to, essentially. And I'm not sure if that's because of potential front running, or I'm not sure what it could be. It's hard to think of a real justification for it, to be honest, for why we can't copy ourselves on a second account and then that number be used as the minimum for the different tiers. But this is actually a really serious issue, because there's a popular investor at the moment who I won't name, who's been demoted from one tier to a tier below, pretty substantial demotion, and they were demoted because they were drawn down. And it's one of the longest periods they've had of drawdown ever. They have a pretty solid track record, and their average was just a few $100s below, what the minimum was for that level, and they've been demoted from that tier. Now that person could have added funds to their account, but that would have been to the detriment of copiers, and that's why he didn't. And so he has sacrificed his own salary essentially from eToro, and is now, because eToro has changed the rules on how long you have to be in different tiers, he is now sitting in a tier below for possibly 3 or 4 months before he gets promoted back to where he was, despite the fact that he was essentially a couple of $100s out, and he could have added funds but chose not to because he didn't want to disrupt copiers. So yeah, the whole situation, I think, really kind of deserves a bit more attention from eToro, and trying to figure out a better solution, I think.
Okay, and so that's kind of from the PI point of view. If Andrew could come in and talk a bit about from the copier's point of view. I watched a video of Andrew's just today. I'd seen it before, where Andrew was discussing the struggle to know how much you've made as a copier on eToro. There's basically no way of knowing it unless you go into your account statement, pull out a bunch of figures, make your own spreadsheet. That shouldn't be the case, surely.
I think it's a really difficult situation, because it's always going to depend on, like, even if you look at someone, like if I looked at Robert's track record, even assuming that's what I would have made, then who knows, if I'd been copying Robert from day one, I might have decided to add some money on depths. So it's all hypothetical and theoretical as to how much I would have made, even aside from even Robert or Jay wasn't depositing. But yeah, that example you mentioned, Gavin, recently someone asked that on my news feed, and they were wondering why their performance was so different from the PIs. And one of them was because the PI had put in a substantial deposit, which, as you see on their bar graph, their results are given equal weighting before and after the deposit. But in terms of real dollars, then obviously the gains or losses after the deposit are much more impactful. And also another thing that I notice people doing this a lot is they add money like mid-month, and then they ask the PI, why did my result not match that month? Well, the answer is, like, say if the PI has made money in the first half of the month and then lost it in the second half of the month, and you've copied halfway through the month, and obviously you've lost. But it's amazing how some people don't clock onto that. So it's really, really problematic. I had to actually watch a YouTube video on IRR and how that all works. I'm not clear exactly how that could be applied, or if that could be applied to eToro stats, but obviously if it could, then that'd be great. But I guess that would only capture half the equation. That would tell you what you would have made if based on the PIs making their deposits, but you might still have decided to make your own deposits out with the PIs deposit schedule, and there's no bar graph or line chart that could ever tell you what you would have made in that scenario if you were doing your own dollar cost averaging.
Yeah, just on that point as well, one thing that I've noticed, I'm still fairly new to this whole thing, so I'm still learning as well. And a lot of people will reach out to me and say, hey, how come my results don't match your results? And I'll look into it, and then I'll realize that, for argument's sake, people in the Netherlands don't have Bitcoin, right? So and I'm like, crap, I can't trade digital assets. Okay, learn my lesson. In future, I won't be trading Bitcoin. Okay, so that's a problem, because if anyone's in the Netherlands, they're not going to have the same results as me. Maybe for better or worse, it doesn't matter. And then someone else reached out to me and said, I can't remember what region it was, but ETFs. It can't trade ETFs in a specific region. And so I think that part of it's got to do with adding funds, and then part of it's got to do with different regulations as well. For me, I think the best way that a PI can operate is equity only, and equity only. I don't know even if there's problems with CFDs if you were to use those. I don't know if there is. Okay, there you go. Equity only and don't add funds. And I think that's the best way that I've learned. Andrew, you'll tell me different.
Yeah, I just want to add another important thing was that even if there was this perfect formula, bearing in mind when you copy the originally invested amount and the PI's portfolio is based on their currently invested amount, those two are never going to be identical. So there's always going to be some element of desync anyway. Even like for example, this year I notice I'm 15 point something percent up on the bar graph. I haven't added any deposits, no withdrawals. 15 point something percent there, but if you look at the line graph, it's 14 point something percent, and that accounts for the fact that at the start of the year, my portfolio, the original amounts and the current amounts were not all identical. That accounts for that discrepancy. Admittedly, a small one, but we saw some people last year had originally invested 10% in Tesla, current value 60% in Tesla. Huge difference. So that's another statistical conundrum. And obviously, the solution would be changed in the whole copy trading system, where when you copied someone, you copied the portfolio they have, not the originally invested values. But that's a whole other kettle of fish entirely.
It's interesting, right? Because I don't know if any of you guys have met Yoni, but Yoni is pretty similar to a lot of the kind of out there growth crypto fascinated PIs on eToro, and I do. There is a part of me that wonders if in the back of their mind they are thinking about just overhauling the whole system, and turning it into some sort of essentially buying shares in a popular investor, and all of those funds go into a pot and then it's averaged out, or whatever, however that works, something a bit more similar to how a traditional fund would work, perhaps. I wonder if that's maybe something that they're considering as well, as a potential solution to this, because as Robert said, when you then there's so many layers to this, right? There's the popular investor adding funds that affects the bar chart, and then you've got the copier adding funds that affects the bar chart, and then you've got the fact that the person can't trade in cryptos or CFDs depending on their territory. There's all of these different things that could be affecting what the copier's performance is compared to the popular investor's performance. And so, the only solution I can think of that really addresses that is to change it from copying to some form of fund management. But obviously that has a lot of potential regulatory ramifications as well.
Okay. Andrew.
Hi. So one thing I'd like to say to summarize really the whole discussion today is that I think people need to take a step back and just look at the bigger picture. You have to accept that eToro is not perfect. The bar charts are not perfect. The risk score is not perfect. PI's claims are not perfect about what returns they're going to get. But as long as you accept that as being imperfect and embrace the overall value and the joy you can get from being part of eToro, then and you're not overexposing yourself to any one investment and you're not pinning your hopes too much on any PI, then you can still get an incredible amount of value out of the investment. And what we want to steer clear of is doing things like saying Robert's made 15.1% over that period and the S&P's made 14.9%, therefore drawing a conclusion on something that's A, a small sample size, and B, is a flawed stat anyway. It really depends on things like have you reinvested your dividends from the S&P, etc. But as long as we don't get bogged down with the minutiae and the fine detail and take these stats as an indication, especially if you've got a long track record, then I think you'll be just fine. And we need to just accept that eToro is not perfect. It's never going to be perfect. We can always work on improving it and optimizing it, but it's still a fantastic place to be as it is in its current form. So overall, really happy to be part of eToro, and I think the eToro team are doing an excellent job. PI team, Sam Rudnick and co, and also the wider eToro product development team.
Just adding on to that, I think at the end of the day, if you don't like the statistics from from someone's profile or from your own profile page or whatever, you can still download all of your transactions. You can put it all into a spreadsheet and you can calculate it in a way that you're happy with. And at the end of the day, I think, eToro and Popular Investor Program would not still be here if we were not, if there were a lot of popular investors that were, repeatedly underperforming the market in some way, or if there was some sort of widespread, misinformation campaign. Clearly, as you said, there's going to be some discrepancies in stats that could be caused for, all sorts of different reasons. But ultimately, when you take a step back and you just look at your own profits from your own copying experience, you can tell from that the system is working, and the system isn't inherently broken. It's more the specifics of how you measure things. So yeah, my advice to any copiers is that if you're unsure about this stuff, then just look through your own stats and download it and figure it out for yourself.
I know, Andrew, you used to copy. You don't do it anymore, and I think you're doing a fantastic job investing for yourself. Gav, you're still pretty much, you've got most of your money in copying, right? Copy funds. What's your experience? I'd like to know your experience, because I don't get very often to talk to people that are. I know Gav's copying my portfolio. I don't get very often to hear from you. What could I do better that every other PI could do better? Like communication, whatever it may be, and as well as that, how is your results differed from mine, even after putting capital in?
Well, to take your first point, you've got the communication thing down, Pat. You're one of the best PI communicators that I'm aware of in terms of your YouTube videos, certainly. And as I talk to all these PIs on the podcast, you get a real flavor for how they differ from one another. I listened to Bees84 the other day, who is like the most hands-on communicator I've come across in terms of how he interacts with his copiers on Discord, and he gets people together, and he's a real community builder. He's doing an incredible job. I don't actually spend too much time poring over the extent to which my stats line up exactly with my PIs. My approach is more, I appreciate that I'm backing a manager, and I'm putting my faith in that person to run the show. And obviously I'm aware of my stats, and I check the PI stats quite regularly, but I don't feel the need to conduct any great numerical calculations to see the extent to which they're in sync. And I have to say, since I bought crypto recently, that's had such a huge effect on my personal stats on a week-to-week, month-to-month basis that I've really no clue until that settles down. Or maybe that's just something you have to get used to when you start owning crypto. It's really mixed the picture up for me. So the important thing is to have a long-term outlook, not sweat the small details on a very short time frame. Give your copiers plenty of time, see how it goes over the longer term. And I'm still a relative newbie myself, and I'm still learning things about the platform. But yeah, that's my approach.
I'll tell you why I asked that, like, about communication and stuff, is I always like I don't know how to communicate to people to say, like, Jay, you say it all the time, like, it's about the long term, it's not about the short term. Because, like, although I'm only max drawdown 5.14%, and that's what it's been since day one, like, it's only been about 5.5%. It's been relatively low. A lot of people lose money copying my portfolio because they copy it for like 1 to 3 days or 1 to 5 days. And I would rather nobody copies, like, I see that and I just feel like, good Lord. The other day, like one day on Thursday, it drops. I don't know if you've seen it. We opened down 2.15%. We ended today down 70 basis points. We're up 1.7% on Friday. But I lost 150 copiers that lost money because they copied for 3 days. And I always think to myself, how can I like stand in front of somebody and say, please don't copy me if you're expecting the next week to work out? Because I tell you why I say that is because if so many people keep hopping between PIs and losing little bits of money, it's death by 1,000 cuts. The whole program never works in that situation. They'll start leaving saying, this doesn't work. I lost a bunch of money without factoring in, wait a second, I only copied for 3 days. This guy's telling me that his positions are like 12 to 24 months. And so that's the biggest challenge I see. It's not necessarily about growing the AUM or growing the copiers. It's more about seeing people succeed, and then the overall program will succeed. And I always wonder to myself, what could I do differently? Like everything in the portfolio, I'm trying to communicate long term. So yeah, that's kind of what I was asking you for. It's I don't know, Jay, you probably gets you down a little bit as well when people are reaching out and saying, listen, I lost money. And
Yeah. I mean, it's not only that, but seeing people give up on a copy when they've been drawn down for a month or 2 months, even, that's still an incredibly short period of time, and you see it all the time. When I got copy blocked in January, I hit like 46,000 copies or something, and now I'm at 30,000 6 months later. So 15,000 people, and bear in mind, like before they announced the copy block, I was somewhere around 20,000. So basically, over half of the people that surged in at that last minute have already left. And I think the majority of them actually did leave with in the red. They left with a loss because they copied in the middle of the month. I had a really good January, and then drew down towards the end, and they lost out. And I think that there's like you have to come to the conclusion that there's only so much we can do, right? All we can do is continually harp on and say, look, long term, look at the long term, speak to other people that have been copying for a long time, testimonials, listen to this podcast, educate yourself about how this works. But, there's only so much we can do. I mean, I do think it would be awesome. I think the suggestion you made in one of the previous podcasts, Gavin, about eToro's educational content could really help the situation a bit. But at the end of the day, we're seeing a huge influx of new people to investing. And, every day it's someone's first day on eToro, I'm sure. And some of them will learn from doing that. Some of them will learn from experience that they need to stay in for longer periods of time. Some of them won't and will lose their money and disappear through the death by 1,000 cuts. But, there's only so much we can do about it.
And many of those who disappear do so with a YouTube video complaining about how rubbish eToro is and how it's a scam.
Well, that's the other side of it, but I get comments all the time in my comment feed saying it's a scam, I lost money. I'm like, what are you talking about? Like, my mom's on there. I ask my mom all the time, is your portfolio up or down? She's like, no, it's up. It's doing very well.
Yeah.
I'm like, well, everyone seems to tell me it's a scam in the comment section. And I think that you have that negative feedback loop because of that's part of it. I don't know, Andrew, you have something to say there. I'm interested to hear it.
Yeah, I was going to say that all the stuff we've been speaking about risk score and stats all goes out the window if copiers' psychology is not right. And I mean, it's just a translation from when people invest in the stock market in general. When they buy index funds, a lot of people come in right at the peak and then they sell at lows. So people or famous investment managers like Lynch, I believe his fund, even though it made 30% per year for 10 years or whatever, a lot of people invested in that and lost money because of the entry and exit points. But yeah, one of the bizarre piece of evidence about investor psychology is you'll see people posting on PI threads saying, I'm just waiting until this gets back level and then I'm out. So they're maybe 10% down. It's a really perverse logic because they're saying the person they're copying is useless, but they're going to wait until it gets level before getting out. So first of all, if that person's so useless, why not just get out right away? And second of all, if they are really useless, why would you think that it would get back level? And third of all, if they did happen to get from minus 10 to level, wouldn't it be worth sticking around and seeing if they can get from level to plus 10? So the psychology in some cases is all wrong. And to be honest, even as a reasonably experienced investor, I've been as guilty as the next person of hopping in and out of markets at the wrong time. And it's just something that it's a psychology thing. I presume it's hardwired into the human psyche.
I mean, I bought Bitcoin at 56,000. I mean, what else do you want me to say? It happens. I think what people need to realize, though, as well, is that like investing is pretty much driven by probability. And when you realize that there is an element of misunderstanding in we're dealing with imperfect information. And so you're always going to make those mistakes. It's about making them fewer and farther between. But the longer time horizon is the easiest thing that you can do to prevent that from happening. And it gets me down when I see a lot of people like lose 1-2%. And then when I look at the portfolio, it's like pending close is like down 0.5%, down 70 basis points. I'm like, okay, there's a person that just lost 2% of their money. I'll come back in a month's time, see how much more they lost. by hopping in between each. And I definitely think communication, Gav and Jay, you guys were saying like eToro's communication could be education could be a real game changer for a lot of people. It really could.
Fantastic. Well, that just about does it for us here on this experimental roundtable episode. Let us know your thoughts, listener. Is this a format that works for you? Fancy one of these per month? It won't always be the same panelists, but there may be a few semi-regulars. Normal service will be resumed next week with a PI interview with an investor who hails from Italy. Today's episode is being recorded on Saturday the 10th of July. Will I be congratulating Italy for winning a major international tournament again? Or will he be crying into his pasta and lamenting that football didn't come Rome? Will there be wild scenes of jubilation in Piccadilly Circus? Or tears of dismay that the years of hurt don't end at 55? We don't know, but you do, listener. Good luck to all involved, and may the best team win. As for the best team I could have had today, winners' medals all round to Jay.
Thanks.
Robert.
We need a clear winner. We can't have runner-up medals in this conversation. We need a winner.
You're all winners in my book.
Okay, we'll take it.
And thanks, Andrew.
It was a pleasure. Thank you, everyone.
And of course, to you, listener, the real champion in my eyes. So there you have the inaugural TotaleToro episode. It was a delight to have that four-way chat. Indeed, the conversation went on for a considerable length of time after recording stopped. 3 great people to chat to. The chat was considerably more enjoyable than the editing process. The things I do for you, listener. That's all from me. You can continue the conversation on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. It's just generic chit-chat. We don't know your individual circumstances, etc., etc., and so forth.